Hello and welcome to another episode of the Real Estate Investing Club. I'm your host, Gabe Peterson, and this is the place investors go to gain actionable advice, learn about current market trends, and hear war stories from other professional investors out there in the field today. Before we get started, I have two quick housekeeping items for you. First, if you like this episode, we would very much appreciate a like, subscribe, and share. It is the best way to support the show and keep it running far into the future. Second, if you're a new investor looking to get started in real estate or an experienced investor looking to take your investing to the next level, I've created an ebook just for you that will cover how to find deals that are actually deals, how to finance those deals with little to no money down, and how to exit those deals for maximum value. On top of that, I throw in an insane amount of free bonuses that you'll have access to once you buy the ebook. All I charge is our admin costs to keep this show running. So if you're serious about real estate investing and want to create both active and passive income as an investor, head on over to the website at therealestateinvestingclub.com and click on the button that says get the ebook in the upper right-hand corner to grab yourself a copy. With that said, let's dive right in. Today we have a very special guest with us, ready to drop some investor knowledge on you. So buckle up, grab your pen and paper, and enjoy the ride. All right. Welcome back to another episode of the Real Estate Investing Club. Today we have with us Joseph Bramante. Joseph is the co-founder and CEO of Houston-based TriArc Real Estate Partners, a wholly integrated multifamily investment company established way back in 2013. The firm is focused on the acquisition, management, and renovation of multifamily properties that produce strong returns while building stronger communities. To date, the company has an AUM, assets under management, of 100 million across 1,100 units. That is a big number. So I am happy to have you here, Joseph. How are you?
Good. Actually, I need to update that. We just closed on 36 million a month ago, and we're under contract for another 7 million right now. So we're closer to 150. It's amazing what you can do in a couple months.
Yeah, seriously, we're going to have to talk about that 36 million. That's a big one. Before we do that, we're going to briefly jump into this. I always start the episode with people's stories. So just kind of briefly tell the people, how'd you get into real estate back in 2013 and how to get you to where you are today?
Yeah, I actually got into real estate in 2011 on my first deal. Didn't form the company until a few years later. So you can kind of see there. I spent about 2-3 years on my first deal, cutting my teeth. I'm an engineer by trade. I was working overseas for Exxon for about 3 years. Total of 5 years. First 2 years I was in country and in Houston, and the rest I was overseas. And that's where basically I made all my money. I was living in some really cool locations in Australia for a year and Papua New Guinea for 2. And then when I was in Papua New Guinea, I was living on a compound. I couldn't spend my money. So it just kept accumulating. And this was 2010 and 11. And every time my managers would come back to the office, they would rotate back and forth to the States, whereas I was permanently based there. They always seemed to own a rental property. So I had a little bit of an ego back then and wanted to show them up. So I had this brilliant idea to buy, they were buying single family, like one at a time. I thought, well, great. I'm going to buy 80. I don't know where that number came from. Me and a friend, we put down a spreadsheet. We're going to take down 80 foreclosed rental properties, single family. And we kept sending this spreadsheet to all these banks in Houston because we needed a loan for $3 million. That was somehow our math showed that we needed a loan for $3 million to buy these houses. We didn't know what we were doing. So anyway, all of the banks would tell me no. And finally, one of them said, just go buy an apartment complex. And so that was, go buy an 80-unit apartment complex. And so that was what the kind of my aha moment. So I read a couple of books, self-taught myself multifamily, at least so I thought, got this kind of 30,000 level experience of what it's like, and then deployed my capital. Me and another partner, another employee, we put our money together. We bought this 26-unit deal out in Houston, Texas, in a great location, sight unseen. We're still living overseas. We did the entire transaction from another country. We had some friends who drove by it and said, yep, looks good. And that was the due diligence.
You're like, all right, sounds good to me.
And so we get into this deal. And within the first 6 months, we find out that the insurance that we purchased was fraudulent, that the property had asbestos. And so we're down 4 units for a renovation. It was a renovation that was supposed to be like $3,000 a door, and it grown to $14,000 a door within a couple of months. Because we just didn't have a scope. We were doing it all kind of like Exxon style, just paying cash, or at least so we thought. And then we were adding central AC to our units, and part of that process, that permitting process, requires an environmental. And because we use this bank called Bank of Internet USA, which is a very sketchy sounding bank, but it was a real bank, but they're not multifamily lenders. And so they had no requirement for environmental. They just checked our financials and they gave us
whatever. Here's the money.
Well, we had to get environmental done, and we got our environmental done and came back hot for asbestos. And we're 4 units down for rehab, sheetrock off the wall. So we send everybody home. We avoid all the inquisitive phone calls and emails, want to know why we canceled the job. And then shortly after that, a month or so later, I ended up getting laid off from my job at Exxon. So I've got this 26 unit property that's 85% occupied, negative cash flowing, has asbestos, doesn't have insurance, and I don't have any income. So it's
about trial by fire, man.
It was a rough period of my life, and we turned the whole thing around. The very next day, I dropped 10 grand to join this local real estate group to get some mentoring, and they put the right network around me. And I think, network's probably the biggest thing you can do in this industry. You just have a really good network of experienced and qualified folks who who've done this before, that are really and that are in your market. I think multifamily and real estate in general is very micro. It's very local.
Yep.
And there's value in using national vendors and providers for some things. When it comes to other things, you've really got to be kind of grassroots and know the local players and know the local title companies and the attorneys and stuff to use, because you use the wrong and contractors, because you use the wrong guys and it'll very, very quickly eat your lunch.
Yep.
So anyway, they got me with the right team. I already kind of like the fundamentals. What I'd read in the books was still valid. I mean, and there was, I already had, I knew the formulas, I knew the math. So the educational side, anybody can read a book and get that education. Still the network is what you can't get from a book. So
yep.
They
fills the gaps.
But they didn't give me too much encouragement, though, to be honest, because everybody there was like, sell the property, take a loss. It would have been like $150,000 loss, and that, I would have probably never recovered from that loss. Not only financially, I just imagine making that money again. I was like, to go overseas again, and when we know what's happened to oil now. This was back when oil was $120 a barrel. So
yeah,
oil has not gone above that. It's gone the opposite direction. So the chances of me now, for sure, I would have never made that money back. I would have not gone overseas again. And also, no investor would have given me money because I have a negative track record. I just lost money.
So what have you done in the past? Well, I lost 150,000.
Yeah, well, that's not a good way to raise money. So nonetheless, I just said, you know what, I'm all in. So I cashed out the 401k, went all in on the deal, used that money to secure a new loan. We did this massive $30,000 per door renovation on a property that we'd spent $25,000 per door purchasing. So it was really, outside looking in, it seems a bit crazy. But we had a good plan. We knew what we were doing. We did this big rehab. We more than doubled the rents at the property, and we exited in 2013 with a 207% return on the refinance. So it was all
Nice.
tax-free, got all my money back, doubled it. And that obviously, it was great for us. It didn't sit well with some of the mentors and stuff at that real estate group, because they don't want that some newbie just joined and showed them all up. But it is what it is. So we used the success of that one to go out and raise money for other deals, and now we're in process of raising and closing on our 12th acquisition. We've ventured off into new development. We've got one new development that we're going to be breaking ground on next year, and then two others in 2022 and a fourth in 2023.
Wow.
We're actually under contract for a deal right now with the sole purpose of tearing it down in 3 years and redeveloping it into a 4-story mid-rise. So we've kind of gone into that new development space because that's one, it's challenging. It's extremely hard, and I'm attracted to challenging and hard things. And two, it's a lot of fun because you get to put your hands in a lot of different buckets. You get to be the politician one day when you're talking to the mayor of towns and getting your permitting done and getting rezoning done, and the other day you get to work with the architects and get super creative on what kind of amenities you want and the style, and you work with the engineers, and I get to try to remember the math that I learned in my
I think I remember this load strength.
Yeah, it's funny. I'm in these meetings with these engineers, and they look at me because they know I'm an engineer, but it's like, guys, it's like trying to speak a language that you once learned a long time ago. I remember some of the words, but and I remember all the concepts, but for the life of me, the math, I just couldn't do it. If you told me to calculate the I don't know, the strength or something on a beam, you'd be in trouble.
Man, that's awesome. That's a great story to start out with in real estate, and I'm really glad that you did come out positive, because you're right. If you had came out with 150 negative, that would be a hard emotional burden to come back from. So glad you guys made that out positive, and now you have a badass story to share with the world. So let's go past the past and let's get into the future. Go into what you guys are doing now. You've already talked about new development. And it sounds like you guys are taking down are they repositions, this $36 million acquisition you're at?
The one we just closed on, that was a standard kind of Class B acquisition. We structured that one with pref equity, really good long-term debt, and what else? And we had some value add components that we're doing. And the way we juiced that one, and that's, the returns these days, to get good returns, you've really it's all about how you structure the deal. We could have very easily done a big bridge loan and gotten the deal done. But because it was 440 units, we had tons of cash flow. We'd structured it with 3 years of interest only. So we had additional cash flow in those 3 years.
Very nice. Yeah. And this is with the bank, you got interest only.
Yeah. We used a Fannie Mae loan. And so what we did was we just chose to finance it, or to finance the rehab via operations. So we've structured it so as a 4-year burn on the operations. Most of it's spent up front. That way we decrease the investor's cash flow outfall. We still get them an average 8% return, but above that, we're funneling all the money to the operational side to finish a renovation. And the renovation was pretty light. It was less than $3,000 a door. So it's a very minor rehab. It's just so many units to spread it over.
Yeah, that's a smart way to go, though, because and with that, you don't need as much money up front. It sounds like your operations, your cash flow is basically funding all of the renovations that you're going to be using to reposition the asset itself. So you don't need to go out and raise that in the beginning.
Yeah, the previous owner had already done a massive renovation, so they took a lot of it. They'd finished a lot of it for us. So we were just finishing up like 20% of the units. We had some other things that we were doing, some value add things that we do at our properties to help further generate returns. But yeah, it was a very, very light rehab compared to other stuff that we've done. And so we felt comfortable doing this kind of structure on it.
Gotcha. Okay. I have a few questions for you. The first one is 100% selfish because, I'm the host, so I got to do this. We are deciding on, me and my partnership, we're deciding on CRM systems to use for management. So real quick, what tools do you guys use that are, that you feel contribute the most to your business?
Yeah. Great question. We're actually in the process of switching ourselves.
Oh, wow.
So we've, as you know, it's pretty expensive stuff out there. You've got your kind of, you've got your generic ones, right, that apply to all industries. You can go, so you can go like Zoho or Hootsuite or HubSpot or all of these are just like generic, or Salesforce is generic. Or you can go specialized, and you've got like the IMSs, the Juniper Squares and stuff like that, where it's strictly for investment management and you've got your investors there and all that. We're trying out this new one called Mast, MAST.io. And we like them. So far, what we really like about them is that they've kind of combined like the Juniper Square plus like a LinkedIn. So you got this social aspect to it. So you go and because if you think about how we as operators work, I mean, you see us all over social media. We're all over Facebook and LinkedIn, and we're networking, but we're networking with a purpose, which is basically to raise capital. And we have our groups, our Facebook groups and LinkedIn groups that we're all communicating within. And what appears like Mass has done is they're adding that social aspect. So they're basically trying to get everybody on this platform. So it's all like imagine LinkedIn, but it's only real estate folks and it's only investors. That's a lot more powerful versus I've got my investors there, but I've also got my oil and gas guys when I worked in the industry. And I've also got whoever I added because they're trying to sell me something or some insurance or whatever. So you get, it's a very, focused group of people you're talking with, which it seems really, really interesting, and I like it. And the other thing is that it's super cheap, and it addresses, from what I could tell, I mean, I'm on the multifamily side, but what it looks like is that they also have the single family side there as well. So like if you're trying to flip a house, or if your listeners are like trying to flip houses, they should check it out because it seems like they're developing a platform that can take the real estate guy from wholesaler to multifamily developer and beyond from start to finish, which is great. Because most people are in that single family realm. There's very few people who do what we do, and there's even fewer people who do beyond that. So I think they've really got a great product, and we're in the process of switching over to them. So far, so good. But cool. I think that was. What I liked about those, I don't do single family. I've actually never done a single flip in my life, but I'm pretty sure that there's investors who do single family that I could show my deals to that would want to do one of my deals. And so that's what I like about it, because I get, we kind of get pigeonholed. We're only talking to people who invest in multifamily, but like 98% of the country does single family flips. That's just where they're at. And so I think it's, I'm excited because now I get exposure to them and they get exposure to me, and probably,
cross-pollination.
80% probably don't qualify. They're probably not accredited, but still it's that 20% who are, and that 80% will someday be qualified. Yep. And so I think, it seems like a really cool platform. And for me, the biggest thing is, or one of the big things is price, because, that stuff is super expensive.
Yeah. Stuff can get way expensive. It's ridiculous. So yeah, we've been using Podio for pretty much everything because it's just kind of a jack of all trades tool. Okay. But we've been looking around. So mast.io, right?
Check it out. We liked it. We vetted it. We think they're great, and we're in the process of switching over. Which is, anytime you switch, it's a process,
Yeah, it's a fun process, right? All that tech stuff.
Yeah.
Awesome.
Exciting where it goes. So.
Well, hey, so. That's awesome. Thank you for sharing that. I'm going to go back to your actual real estate stuff, even though that was real estate. You mentioned value add. So you guys, when you buy the properties, you do specific value add. There's strategies that you do for adding value to the properties. Kind of go into that. Like, what are the things that you look for that really do add the most value to the property have the biggest ROI when you're talking about the fix?
Yeah, trying to give away my secret sauce here. We've got our list, kind of our menu of items that we'll look at applying to each property. We know that, if we're going to do X, that we can get Y kind of bump, and usually it's a tested thing. So we know that we'd like to add smart tech to our units. It's, that one honestly is a bit of a gray area, because it can be so expensive. You can spend $800 to $1,000 per unit putting smart locks, smart thermostats.
Okay, like Nest and that kind of stuff.
all that stuff. So when you
Gotcha.
factor in the hardware and install costs and everything, it can be, 800 or so bucks a unit.
Yeah.
But you can get 20, 30 bucks a unit premium. We use a service called Duello that does all that for us. And they charge us a monthly fee. So it takes out some of the upside, but the benefit for us is that not only do we get the upside when we lease the unit, but whenever they vacate that unit, it converts it into vacancy mode. And one of the big issues you have in the industry is when the unit's vacant, you go and you make your turn. Sometimes the contractor will leave the AC running, or they'll leave the lights on, and you're paying for an electricity bill, and you may not discover it for weeks later by the time it finally fills. So this system, it automatically cuts all that off. You eliminate that as even an option. So just, that's some of the things we do. So we've got many items like that. Adding yards to units. You can spend a couple $100 on a yard, and you can charge more money for it. What we like about yards is that you get kind of a 2-for-1. So you're not only charging for the yard, but you're indirectly marketing to pet owners. If you have a pet, you really want a unit with a yard. And if you have a pet, you also have pet rent, pet deposits, and everything else. So, you get more money than what's just charged for the yard. So those are just two of the items. And we've got just a handful of other items like that we look at applying to every unit. Some work, some don't.
That's interesting. I've never looked at pets as an additional revenue source. So you always hear, investors like, no, I don't want pets. It's going to ruin the property. But you're right. I mean, you charge an additional pet fee, so that could be, a small bump to the top line.
And also, if you're doing hard surfaces throughout, if you do vinyl plank flooring, and if you're, mostly just the flooring, if you got all vinyl plank flooring throughout the whole unit, there's not really much that you can't fix with a mop. Or if they smash something, you just drop it down. It's $1 per plank, so it's not even a big deal to fix it. So I think people should reconsider the pet thing, and you can make good. It's definitely a good profit center.
Yep. That makes complete sense to me. Okay, so I'm going to push us into a new topic, new development. You already talked about it. It's not something I've ever done, so I have zero experience here. I've heard a lot of people going into new development. It sounds sexy. What actually, why did you decide to go there in the first place? Why not stick with established assets?
Yeah, well, because we've been doing such large value add deals, and we were seeing over time how the spread continued to compress as far as the price point. So we'd pay X dollars for this fully renovated property, or we can pay a little bit more. We can get a brand new Class A asset. And as the spread, the difference in the price per door kept compressing, eventually it makes more sense. Just go build something brand new, pay a little bit more for it, but the downside is completely solved. You don't have to worry about things breaking. It's, you've got a more long-term asset. And so I think that, it's kind of like, I think every good operator will eventually kind of graduate, and not to say you're bad if you don't graduate. So preface that. I'm just saying, as you grow, what we found was that it just made more sense to go into the new Class A, or at least the newer assets, where we're not, where I was originally buying 1960s and 70s product. Now we're only buying 80s and 90s product, and also doing new construction as well. So you get to where you don't want to buy the older stuff, because the older properties have lots of risks that come with them. And then also you run into, things will age out. You'll reach something service life, and it's going to become harder and harder for you to lease a product as a new product is continued to be built around you, and people get a bit spoiled. They get, nobody wants to drive a 1980s car for the same reason you don't want to live in a 1960s property. You can get it for a great price. Yeah. But, it's, when you start looking at the people who are interested in living there, you quickly start losing value because you're dropping rents, and it just gets to be a nightmare. That said, you can really do a lot of work on value add side. We're completely, we bought a property a year ago that we're spending $37,000 per door on. It didn't make sense to develop. And you walk into the property and it's absolutely gorgeous. We've redone all the plumbing. So you can do stuff like that. We probably added another 10, 20, probably added another 20 years of life to that property and made it completely relevant and attractive. But not everybody's going to do that, right? That was a huge investment, and most folks would much rather say, you know what, I'm just going to tear it down, and I'm going to add 100 years of life to it by redeveloping it and putting something new. So we went into new development because we saw the spread compressing and the risk profile was a lot different. And you actually make significant money as a developer. People always say Class A is bad because they're really thinking about it as when you buy it from the developer.
Yeah.
But when you're a developer, your construction costs are typically a lot lower than what it was cost to than what it's worth on the market. Otherwise, you wouldn't have built it in the first place.
Yep.
So we view it as, we're going to be the developers and we're going to be long-term holders of these assets. So we'll build it, we'll refinance out, we'll get all the investors their money out, and then we're just going to cash flow like crazy. And so we'll have additional upside on our deal versus somebody who bought it from what's called a merchant developer. A merchant developer is a developer who just builds and sells, and they don't hold. Yep. We are a kind of build and hold developer. And so by doing that route, we're able to buy something, build something at a great price and cash flow it at a great rate and get great returns on it because our basis is much lower than somebody who bought it off the market.
Yep. That makes complete sense. And it makes, I'm sure, double sense in markets like Houston, where you guys have just kind of been skyrocketing. Like here in Seattle, prices have just gone through the roof for the past 10 years.
Yeah, Houston's done well. We've got a lot of sprawl to our city. It just, when prices start getting too expensive, people just go further and further out. But I think now we've kind of reached the limits of traffic commute that people are willing to tolerate. And so now you really start seeing.
I don't know. You look at LA, it's like people are willing to go pretty far.
Yeah, there's a certain sector of people who would be willing to go pretty far. I think LA is a unique animal. You can't really compare many cities to LA. Here in Houston, I feel like people are not, well, I think once you start getting above 45-minute commute one way, hour commute.
I wouldn't do it.
Yeah, people are like, that's an hour of my life. So you start looking at 2 hours each day. Now you start willing to pay more, and we've got Class A stuff in Houston that's popping up with, I don't even know what the per square foot is. I've been looking at them personally, and they're, one bedroom starting off at over $3,000. You got 2 and 3 bedrooms at $4,000 and $5,000 a month. You've got some really, really high-end stuff going in Houston and in our Galleria areas and River Oaks, stuff like that, there's definitely a profile that's willing to pay to live central and not have to commute that far out.
Yep. Makes sense. Well, shoot, man, we blew through our 20 minutes, so I got to push us into the quick question round. This has been a pleasure for talking to you, though. You have a lot of good wisdom to share here. So quick question round. I'm going to ask you quick questions. You give me quick answers. It all starts with books because I'm a big bookie. So give me 2 book recommendations, one for real estate investing and then one for just general life wisdom.
Real estate investing, Multifamily Millions by is it Dave Lindahl or something like that.
Yeah. Yep.
It was one of the first books I ever read back on Kindle in Papua New Guinea in 2011, 2010. So,
one of the first Kindles.
Yeah. Which that book, by the way, is a terrible book to e-read. There's some books that you just got to have hard copy on because I have notes all over it. Actually, my book, I've loaned it to a friend, and damn it, that guy never gave it back. So, but
hopefully he's listening to this.
Hopefully he's listening to it. David, my book
back. Next question is habits. So if you could go back to the Joseph who was 2011, who just saw that his boss was going out buying properties. He got that gumption in him, wanted to go do the same thing. Go to him, look him in the eye, give him one piece of advice moving forward.
Buy more multifamily.
Easy. You're not the first person to say that. That's funny.
Yeah.
Next question is your superpower.
Honestly, it would have been don't do the big rehab, buy more and just buy everything at $25,000 a door.
Oh yeah, especially 2011 for sure.
That rehab is a great story. I love telling it But what people forget is I spent 3 years on one deal. That's a lot of time. Imagine how many properties I could have bought. If I'd have bought 3 more properties, 1 per year, that would have been great. So
Yep, for sure. But you got the story, so that's good.
yeah.
Next question is an opportunity for you to brag a little bit, flex your muscles. So what is your superpower? What are you really good at?
I would say the underwriting side and creative underwriting. It's really hard to find deals these days. And our last deal is a case in point, figuring out how to structure it so that it made sense. And we produced some pretty killer returns to our investors on that, over 20% IRR on that deal over a 10-year period, which is incredible. And so I think just being really good at the underwriting, I've underwritten over 20% of the Houston portfolio. So we've done a ton of underwriting, and it's one of those things that it doesn't cost you a dollar to do. You can take courses that'll cost you money, but you can also underwrite for free, and you can just contact brokers, sign confidentiality. They'll give you the numbers. And this is my number one recommendation to folks who are just starting off, is just underwrite every deal you can. Even if you have no intention of buying it, contact the broker, get the numbers, follow the deal through the end, and then find out what it officially sold for and see how that number compares to your number. And just keep doing that over and over again until you get pretty close. Because that's what it's really worth, right? That's how you can get good at it. Otherwise, you get people who've never done it before. They took a course, they did the underwriting, and they're not comparing it to anything. They just take it as it's correct, versus you should probably spend a year or more looking at your numbers versus what somebody else who's in the market is actually buying it for. And then also I would recommend to further improve is make sure that the deals you're looking at are over, let's say 150 units, 200 units, just because of the guy who's buying that property probably knows what he's doing. And so you don't want to get into the situation where you're looking at 20 unit properties and you're trying to match with somebody else who's buying it at 20 units, which probably might be his first deal also, and could have way overpaid for the deal. Yep. Because people tend to be very emotional buyers when they're just starting off, or they just don't have their numbers right. So go after bigger deals for your own education, because the buyer typically knows what he's doing in that situation, and you can kind of you want to emulate them as close as you can. So.
Yep, I love it. And we have, for people listening and watching, we have a kind of a mini due diligence / quick analysis guide that's free on the website, so you guys can check that out. Very, very, standard. So don't use it for, big deals, but it's useful to kind of get familiar with this stuff. All right. And last question about real estate. And this is your places. So you're down there in Houston. I'm sure you really like Houston, but that could be your answer. What is the place that you kind of are excited about? What areas are you excited to invest in right now?
Yeah, we like Corpus and Victoria. In Houston, we're interested in, I actually just got an email this morning or a message from a friend of mine who just closed on like 5 acres in Austin. So we're looking at doing a development there. I don't know. We like, right now we're really excited about the Garden Oaks area, because in Houston, we bought a property a year ago there. We're under contract for a property there now. We've got 3 other properties in that area, and that whole market has a lot of retail going on. It's kind of, within every market across the country, you've got pockets of it that are booming and some that are busting. And this is a booming submarket within Houston. And it's exciting. We got Hines is doing a big development. You got 5 other developments going in that market, and so we're excited to see how it's traditionally been mostly a single family market where they've got these houses on these 1 acre lots, and you got these developers going in buying 5 houses and putting an apartment complex, or they'll buy 1 house and they'll put 14 townhomes. So they do these really massive developments, and it's completely being turned around with, you got tons of retail that's being repositioned, which I think that is it's one thing to reposition multifamily and do that. I think there's a pretty well beaten path, and you can go down that route, but and maybe it's just because I don't do it, but it just seems to me like flipping retail, it's so artistic and creative in what they do, and it's either a huge success or a huge flop. when they do it. And there's kind of no middle ground, it just seems like. So hats off to those guys.
Yeah, for sure. It's not something I've done, but in the future, maybe. And final question. This one is for the guests. You've given us a lot of good advice, good things to follow. So I'm sure people want to reach out to you. What's the best way for them to do that?
Yeah, check out our website at triarccapital.com or shoot me an email at invest@triarccapital.com. Otherwise, I'm always active on LinkedIn, or maybe check me out on mass.io. I'm going to be there, and he'll probably be one of the first people to reach out. So he could be my first follower. So we'll see how that works.
First person on Facebook back in 2000, whatever that was, 2009. Awesome. So I will put that link in the
the Tom of MySpace.
I love it. Yeah, there's not many people will get that joke in a few years.
Yeah, you're right. Sorry, I gotta
remember. Awesome. Well, hey, thank you for hopping on the show. For everybody who's here listening and watching, thank you guys for showing up. If you want to reach out to Joseph, I'm going to put his link in the show notes. So just click a little more in the description. It'll pop down the full description. You can get everything there. Other than that, Joseph, thank you for being here. For everybody who's here with us, thank you guys for showing up. If you have any questions, reach out to us. As always, we appreciate likes, subscribes, and shares. It's the best way to support the show. Other than that, hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode.
Thank you for joining us for another episode of the Real Estate Investing Club. I hope you guys enjoyed the episode as much as I enjoyed putting it on, and we're able to pull some actionable advice that you can apply in your own investing today in the field. Before you go, we have a gift for you. If you're a new investor looking to get started or an established investor looking to take your investing to the next level, I've created an ebook just for you, available on our website. This ebook will cover how I was able to create both active and passive income in real estate with very little money to start with. In it, I will address the 3 most often cited obstacles new and veteran investors run into by showing you how to find deals that are actually deals, how to finance a deal with little to no money down, and how to exit those deals for maximum value. And if you get the ebook today, I am throwing in a bundle of bonuses, 7 of them to be exact. The first one will be the off-market lead generation blueprint, which will take you through the exact systems and processes we use to generate off-market leads like clockwork, which is the most important skill when it comes to creating wealth in real estate. The second bonus is the A to Z REI systems and vendors guide, which will allow you to peek under the hood of our business and see the exact tools, systems, and even the vendors we use to see the success that we do. And the third bonus is the top 100 best performing keywords pack, which will give you the exact keywords we use to target motivated sellers online using PPC ads. The fourth bonus is our contracts bundle for wholesaling and renting real estate, which will give you access to all the contracts we use in the field to execute all different types of transactions. After that is the Investors Quick Analysis Calculator and Offer Tool, which will allow you to quickly calculate whether a deal is an actual deal and will allow you to create an offer automatically from those calculations. This is a lot of bonuses that I said. I'm just going to keep going down the list. Number 6 is the Investors Daily Success Tracker, which is a tracker you can use to ensure you are taking the right actions day in and day out to reach your financial goals in real estate. And the last bonus is the Wholesalers Template for Quick Assignment Cash, which will give you the templates we use to present our wholesale deals professionally and efficiently to our buyers. Whew, that is a bundle. So it's a mouthful. You get all of those bonuses for free when you download the ebook. All we charge is the admin cost to run the show. So if you're interested in the ebook and the bonus bundle, head on over to the website at therealestateinvestingclub.com. Click on Get the ebook bundle at the top of the page to take advantage of that deal. And with that said, I hope you have a fantastic day, an even better week. Keep rocking real estate, and I look forward to seeing you on the next episode.